Something big is shifting beneath the surface of the market, and most investors have no idea. Stocks might still be hovering near their highs, but the underlying data is starting to fracture. And if these fractures widen, they could shape the entire direction of 2026. Let's start with the most overlooked threat. The Supreme Court is preparing to rule on a case that could force the government to refund more than $1 trillion in tariffs collected during the Trump years. Prediction markets are pricing in an 80% chance that the ruling goes against the government. And here's why that matters. That tariff money has already been spent, meaning a reversal creates a $1 trillion vacuum in the federal balance sheet. If that happens, it doesn't just hit Washington, it ripples through markets, bonds, interest rates, inflation expectations, everything. Now layer on the second signal, the labor market. October wasn't a slowdown, it was a collapse. The worst month for layoffs in over 20 years, and it's not the usual cycle of cost cutting. Companies are replacing entire job categories with AI tools and automated systems, scaling back payroll faster than they ever have. Meanwhile, job openings are falling off a cliff while the S&P keeps pushing higher, a divergence that historically ends with one thing: the market eventually catches down to the real economy. And then there's the consumer, the last pillar holding this market together. Credit card and loan delinquencies just hit their highest level since 2010. The strong consumer story of 2024 and 2025 wasn't strength at all, it was debt. And now that debt is starting to break people, spending is slowing, savings are gone, and the pressure is building. Add all of this up, and the so-called stability we saw this year starts to look more like the calm before a storm. Not guaranteed collapse, but a market that's far more fragile than the headline indexes suggest.